Buying call options made simple.
By GreenMoneyWatch.com.
Pause the video and read the disclaimer. This presentation will be talking about buying call options, and I want to make this as simple as possible. What are call options? Call options are basically a contract. And in that contract, it gives you, the option buyer, the right, but not the obligation, to buy stock at a specific price within a specific time period. The stock is called the underlying asset. Now, the underlying asset, when you're buying a call option, you expect the underlying to increase in value. So that means you expect your stock to increase in price. However, it must increase in price before the expiration date, because all options have an expiration date. So remember that. All options have an expiration date, and all options will increase and decrease in value. Now, this presentation is just to give the basics of buying call options. However, there is much more information that goes into option buying and option selling. However, we want to start with the basics of buying a call option. And this presentation will give you that basic information. This is one example. You buy a call option on, we'll say, company ABC. At the time you buy this call option, ABC stock is worth $20 a share. But a call option will cost you $1.50, and it expires in 45 days. Now, $1.50 is the same as $150. And the reasoning behind that, because each option contract is equal to 100 shares of the ABC stock. So one option contract is equal to 100 shares. So that's $1.50 times 100, which equals, of course, $150. So if you're hearing people talk about options and you're hearing them talking in numbers such as it cost me 50 cents, or it cost me $1 for an option, it cost me $10 for an option, that's what they're saying. Especially if it all depends on the number of contracts, of course, but let's just assume we're talking about one contract, and that's going to be times 100 shares. Two contracts times 200 shares, and so forth. So just remember, one option contract is 100 shares, and if you're in a discussion and you're talking about, and you're hearing someone speak of option contracts and they're speaking in smaller numbers, just times it by 100 for one contract or the number of contracts. So buying one call option contract gives you the control over 100 shares of the ABC stock for at least 45 days. So let's say ABC stock increases to $30 a share, and it does that 22 days, within 22 days. Now you have 45 days to expiration. So within 22 days, now ABC stock is worth $30 a share. Of course, now this is great news. So now your call option is now worth $15. And remember, we're talking about one contract. So that's 15 times 100, and it's equivalent to $1,500. So now your call option is worth $1,500. And remember, you originally paid $1.50, which that $1.50 means $150, but it's now worth $15. So your profit at this time is worth $1,350. How do we come up with that? The $15 minus your $1.50, and remember we're talking about one contract, so you're going to do times 100. So that's $13.50 times 100 because you purchased the one contract. Now, if you have purchased, let's say you have purchased 100 shares of ABC stock without using options, so you just purchased it outright. That 100 shares times $20 a share, which would have cost you $2,000, and now it would be worth $3,000 because now it's $30 a share times 100 shares. Now your profit would be $1,000. Now, as you can see, options give you more leverage. Now your option profit is $1,350, where if you would have just bought the stock outright, it would have called, your profit would be $1,000. So remember that options give you more leverage. However, the difference is you can own the stock forever. However, you cannot own an option forever. You only own that option for 45 days. Okay, let's say ABC stock goes to zero. Bad news. Goes to zero. Now, if you bought the call option, which you paid $1.50 for, which of course, as we've learned, is $150 for that contract, that would be the most you could lose. That would be the most you can lose is what you pay for the option contract when you're buying options. Now, on the other hand, if you purchased ABC stock outright, at least 100 shares, you would be out of $2,000, because remember, it was $20 a share initially, and you purchased 100 shares. So these are some of the differences between buying options and buying the stock outright. Now let's look at a real example from GreenMoneyWatch.com alert service. On Sunday, September 16th, Green Money Watch placed out a high probability alert for the company with that ticker symbol HCA to show upside movement within the following 10 to 15 trading days. Green Money Watch also gives profit taking target ranges, and for HCA those ranges were $138.89 to $143.15. This was messaged out to all the Green Money Watch subscribers at the time. HCA closed Friday, September 14th at $133.63. So Green Money Watch suggested if it closes below $131.55, the trade would no longer be valid, which means that that's where you can place a stop loss or you can exit the trade at that time to prevent further downside losses. Green Money Watch also suggested buying an at the money or in the money call option with 20 plus days till expiration. This is our Thinkorswim platform provided by TD Ameritrade. And using the Thinkorswim platform, it allows us to use an on-demand feature to better explain this example. So on September 17th, as you can see, the time here, 9:58, the market, this is Eastern Standard Time. And the ticker symbol HCA, which was the suggestion given by Green Money Watch. At the time, the price was $132.90. And you can see here, this is called an option chain. And this is your call side, and this is your put side. We're just going to focus on the call side now, since that's what we're talking about, buying calls. And your shaded area here is what's considered in the money. So on your alert, if on your Green Money Watch alert, if there is a suggestion to either buy an in the money or at the money or out of the money, this is what we're talking about. So the shaded area is considered in the money, and we will talk about in the money, at the money, and out of the money on another video. The at the money is the price, the strike price that's closest to your underlying price here. So it's 132.90. So the strike price, or the at the money strike price, is 130. So the 130 strike. The out of the money is all this area that's non-shaded. And most platforms will
be similar. Most of your in the money will be shaded. Your at the money will always be the closest price to the underline, the closest strike price to the underline. So generally, it'll always be the first shaded box, and your out of the money is your unshaded. So we purchased a 130 strike, our at the money strike, which cost us $5.25, which, as we just learned, is equivalent to $525 per contract. And the bid and the ask price are here. 525, actually the mid price that we paid.
$130 strike price is at $10.70. As you can see here, this price, able to get it at the ask price, which is sometimes not always the case. Sometimes you'll get it what's called the mid price, which is in between the 1030 and 1070, but it's not written in stone. So as you can see, the 130 strike price is now worth 1070, which is equal to $1,070 per contract, and we were able to take profits there, which gave us a profit of 545. That's excluding trade commissions. Profit 1070 minus 525, which is the original premium we paid.
For more information, visit GreenMoneyWatch.com.